Cordes Larson. I'm Gloria Cordes Larson, former president of Bentley University and a member of NACD New England's board of directors. I'm going to be serving as moderator for today's podcast, which is a jointly supported program of NACD New England and the Philadelphia NACD program. I'm delighted to have an audience join us today because we have two guest speakers who led the conversation 2 weeks ago about the 2025 Proxy season look back, as well as the difficult road ahead as we all go into 2026. There were a number of audience questions in the open chat that we didn't get a chance to respond to, and as well as a few additional questions related to the program that we might get to if we have time today. But by way of quick reintroduction, Paul DeNicola is a principal at PwC's Governance Insight Center, where he works to extend the firm's thought leadership in the area of corporate governance. In this capacity, he also advises boards and executive teams on emerging governance issues. Jessie Lochmann is a partner with Foley and Lardner and co-leader of the firm's capital markets and public company advisory practice. She practices corporate and business law, also regularly advising public companies and their boards on corporate governance matters. So just to set the context really briefly, going back to our September 11th Proxy program, Paul, you had a great overview slide that discussed 3 buckets of important categories for boards of directors and their companies to consider: shareholder engagement, what happened in 2025 and the road ahead; shareholder proposals; and then the third category is shareholder activism. So I intend to follow that framework today because maybe it's not surprising that given the flow of the program, our questions pretty neatly fell into those categories. So I do want to start with shareholder engagement because it kind of was the big elephant in the room for 2025. And Jessie, you did a great job in that early discussion of what happened with engagement, the seismic change that happened, talking about SEC guidance. And I know there were several other factors, but primarily SEC guidance that led major institutional shareholders to adopt a new, significantly more cautious approach to engagement with companies. And what you saw, and Paul, you discussed this as a trend that then flowed throughout the proxy season, was continued traction in what you refer to as a listen-only approach by major shareholders. So you also, I thought, gave our audience an incredible amount of information about proactive things that companies and the boards that guide them can do going into 26 with a very different approach, kind of taking that lead. So here's our first question. It's a bit of a look back about what used to happen and now what's happening applied to specific issues. How were large institutions engaging pro-ESG, CEO chair separation, or compensation policies, and how have they shifted since February of 25? I think it would be interesting if you could, both of you, starting with you, Paul, maybe take a minute to talk about sort of what happened before and how this is reflected when we're talking about some issues that have, over the last, say, half dozen years, have growing importance to large investors, like the ones I just mentioned.
Yeah, sure. Well, great to be back. Thanks for having us both back again. Yeah, I mean, clearly as we discussed last time, the overall engagement landscape has changed. So with regard to, the issues from the question, ESG, CEO, chair separation, exec comp, I'll start with just a couple comments. And, I think overall engagement conversations around ESG related topics haven't necessarily changed. We haven't seen any radical differences in investor proxy voting guidelines, but when you look at the result of the shareholder proposals, they clearly didn't get enough support to pass. On the more sort of pro ESG proposals, you certainly have the delayed sustainability reporting that we talked about, and trying to make sense of what that means within the context of a sort of broader regulatory environment. The other thing that we didn't mention is that for many of the largest asset managers, they've actually split their stewardship functions. Um, some a little bit differently, but certainly among the big three, between passive and active, those who are focused on more sustainability related voting, sustainability or decarbonization in one case. So depending on uh, which stewardship function you're talking about within the asset manager itself, you may have a different experience with engagement. So maybe I'll stop there before we focus on CEO or chair separation. Jesse, you want to add anything?
Jesse.
So it's interesting. So we had everything Paul just said, and again, thank you very much for having me again, but had everything Paul just said, recognized during this season. But I also saw a bit of a shift as we led into, the calendar year proxy season, given regulatory changes, given political turmoil, so to speak, that some of my clients almost found that there was reluctance in the part of the investors to even engage or to share a position, because some of the investors themselves were evaluating the positions that they were likely to be taking on some of these topics. And so it was an unusual beginning to 2025, not only because, again, of US presidential administration shift and executive orders, also companies reacting to that in terms of their business, in terms of, as Paul said, pull back on sustainability reporting in some cases, but then also having even some of the larger investors again, showing some reluctance is the word that I keep coming back to, but maybe some expression of uncertainty within their own voting policies. We saw that with ISS and Glass Lewis as well, reacting very quickly to, what they saw as a changing landscape. So it put our issuer clients or corporate clients in a very difficult position of not knowing how some of their largest investors and the proxy advisory firms may react to a wide variety of proposals that may be brought to them by a third party or to their own, ongoing business practices and reporting. So ESG just became very complicated, not only as the companies tried to figure out what was best for them and how they would comply with whatever was different and new, but how they would react to a very uncertain set of, rules and policies and guidelines being, brought to them from the outside. The 24 proxy season, it felt more, comfortable around, what the expectations were. The largest investors were saying what they wanted to see in proxy statements. They were expecting certain disclosures. Whether companies made those or not was a business decision, but at least the expectations were more widely known. This year, that was much more complicated. And I certainly think the hope is going into 2026 that investors will be more clear as to, their external policies. So even if there's maybe not quite as much engagement with the larger firms, the policies on the part of those third parties will be more clear, and there will be, an easier opportunity for our corporate clients to decipher what it is that, is expected of them to achieve certain votes.
I think that's really helpful. And I think it also relates to the division that you were talking about, Paul, within the major institutional advisory firms, because asset manager firms, because it speaks to going forward, being compliant with the SEC. And at the same time, how do you, and you were getting to this point, how do you feel more comfortable about the way your positions may be better understood without falling out of compliance? And I'd also like, before you have anything else to say about that, Paul, I do want to go back to you for a minute about the CEO and chair separation, because that's a pretty classic governance issue as opposed to ESG.
Yeah, that is more straightforward in my mind, with the exception of a couple of very high-profile situations. If you look historically, the largest investors have been relatively reluctant to support shareholder proposals that seek to split the roles of chair and CEO. I mean, that's just the historical data. That being said, on average, those types of proposals have gotten about 30% or so support historically. A lot of that has been due to the support of smaller investors. I would not expect either engagement or voting around that particular issue to shift very much. Although we did speak about how the change in the engagement landscape amongst the largest investors actually presents a different opportunity to engage with your smaller investors, right? The top 15 or 20 investors. So that may have some shifts there, but I don't see a big change coming on that topic.
That's great. And we also have a question that more directly gets to some of those smaller investors in a second to add follow-up. Jessie, would you add anything?
Nothing further on that point.
Okay, so I'll move on to question 2, which is the comments about large institutional investors shift to listen only were interesting. What changes, if any, do you anticipate with respect to how smaller, more active investors, including activists, will engage going forward, either due to the shifting regulatory environment or other factors? And Jessie, you did do a bit of a deep dive in our program on the 11th about great idea to start looking further down the list at your investors for who can feel more comfortable in many cases with a higher level of engagement. So why don't you start this conversation?
Sure, happy to. I actually have a number of clients who are taking that opportunity right now, post, their annual meeting, to engage with their IR team, to engage with Proxy Solicitor, a firm that has an understanding of what, the depth of their investor chart, so to speak, looks like, and, which of those investors are most likely to have an interest in engaging, and trying to create this off season, out of proxy season engagement cycle, trying to recreate it in a different way to ensure that there is, access to investors and that voices are being heard, and really being very, critical thinking around, which of these investors have shown a lot of long-term support, but are staying below the 5% for various regulatory reasons or, their own policies, and looking to build those, relationships as representative of perhaps, the larger institutional investor base, so that there's dialogue, so that the management team feels comfortable and confident that they're, listening to their shareholders, so that they can be reporting in the proxy statement, what shareholder engagement that they've accomplished, because that is important to a lot of companies, and to ISS and Glass Lewis, especially if there's been an issue in compensation or otherwise, to demonstrate that you've had that interaction and that engagement. So looking for ways to, create a new cycle of engagement. And now is the time really to be doing that, because for calendar year companies, right, this is, going into the fall would be the right time to be looking for that engagement. Other thoughts are investor conferences. Different investors are likely to, be asking for meetings, and, keep track of that and understand, who is, participating that way, asking questions, understand who's listening to your earnings calls and participating that way, and really get a feel for, what is that group of shareholders that is active, that's engaged. We can get to this later on the activist question. It's important to follow along for that as well. But really, in the positive side of things, understand who, is really, paying a lot of attention and seems to be an engaged and enthusiastic investor, and really looking to reach out to them.
It does feel like, and we will get to a couple of activist related questions, it does feel like it's also an opportunity to remind yourself as a board and company to think like the activists. And you may find through this more intensive type of engagement further down the line some things that you need to talk about. Gee, where is this headed? Paul, do you have some other additional comments that you would add?
The only thing I would add to that is defining engagement. And engagement, it could be direct engagement, right, where between the board or the company and the investor. And, it could also be, if I put myself in the role of a director, listening to the perspectives of investors at director education programs like those that NACD does, right, where you hear points of view, policy positions there. So there's, that sort of direct engagement, but there's also kind of tertiary engagement approaches that board members, I think, can take.
Thank you for both of those sets of comments. I want to move on to shareholder proposals. We've already dipped our toes into the environmental and social proposals, which, along with some additional guidance from the SEC, we also saw a continued drift down in the numbers, the volume, and the support for those proposals. But at the same time, we saw the anti-ESG proposals, specifically E&S, literally fall off the cliff. And it seemed, I know, Paul, I think you raised this, but it seems like if you really bore down as you did at PwC and looking at the data and in your report on what's actually happening, the maturing of disclosures and the interest in sort of so many companies now are saying more, disclosing more, and often using the right accepted standardized metrics around diversity and climate. So the question, not surprisingly going forward though, given sort of the tug and pull between the anti and the pro and regulatory concerns, both federal and state, the first one is, what do you think about disclosures diversity, about diversity going forward? Given the politicalization that you were referring to, Jessie, and Paul, this whole notion of, is there a Goldilocks way to thread the needle these days? And maybe we'll start with you, Paul, for a few comments and then go to Jessie to add on.
Sure. So we've already started to see some data that's telling us that the disclosures have decreased this year around diversity, and I think we'll see this trend continue to evolve. I saw a study that looked at the 2025 proxy season around director demographic disclosures, which showed a steep drop there, particularly around disclosures that had at least one quantitative measure of board diversity declined among the Russell 3000 companies from the mid 90s to the mid 50s proxy season over proxy season. So the data is there, and I think you're going to see this trend continue.
Jessie, what do you tell your clients?
Well, what I found was interesting, that's the best way, to frame the question. What I found was interesting were these conversations I was having with clients around, one, wanting to avoid, being the target of anything unknown by, including the wrong thing, right? So they were asking questions about that, but also balancing that with many clients, sort of the importance of diversity to various stakeholders within the company, to the board, to the company strategy, right? How to balance that. And I think that's, I didn't see the exact, statistics or data that Paul referenced there, but you can see why 50% of companies were still disclosing something around demographic data because of this balance around what's appropriate from a business strategy. How does this company feel that from a governance standpoint, from a telling its story standpoint, it wants to share this information? I think it's an opportunity in a lot of ways because there are fewer prescriptive requirements, if any. And so companies now can tell their demographic story in a way that fits their company strategy. But what's interesting when I say that is that a lot of companies weren't quite sure yet what their strategy was, right? And it wasn't that they didn't appreciate or value diversity. It's what is our strategy around how we're demonstrating this and how we're highlighting it as, a key area of our governance oversight. And so I know this is consistent with what I said about ESG, but I think as we move into 2026, boards will have more time and they will have had more time to really think about this, right? What's meaningful to us? What are we truly evaluating? What value do we see these various categories of diversity bringing to the board and therefore to our shareholders? And how best do we want to share that information? So I'm framing it with clients as an opportunity. This is an opportunity for you to make disclosures that fit you rather than simply reacting to what investors expect to see, what ISS expects to see.
So think harder about what is your business strategy, particularly as you look at the road ahead. Where do you want to be in a truly sustainable way multiple years down the road. And I just want to mention that, a specific example that I'm personally really attached to, which is 3, 4, really almost 5 years ago, Unum, a Fortune 500 company, decided to go with I&D. And it was because we were hearing, we're based in Chattanooga, Tennessee, but we also have a major campus in Portland, Maine. Differing views among employees to start with about how to attach to these issues. And just finding that if you start with everyone's in the room, it's inclusion. We believe in inclusion, but here are the things that are driving us to make changes in, and using again, what now I think is more common, the diversity of perspectives, cultural perspectives, and all of that you can bring to bear. And it feels like some of that I have seen playing out in other companies more recently. And Paul, I sort of wonder what your thoughts are about this. How do you thread the needle? Can you get the porridge just right without Robbie Starbucks or some lookalike, invading your thinking?
Yeah, I mean, there are a couple things here. I mean, you have to draw from the data, right? But the data points to a trend line. But I think when it comes back to the importance of board culture and the board understanding what the corporate culture is, which is shared oversight, that's where this issue, I think, falls in. I think that speaks to Jessie's comments on using this as an opportunity to have it focused back on strategy, the board's role and oversight over that strategy, not having a knee-jerk reaction necessarily to what is going on in one particular news cycle. I mean, there's been an awful lot. Well, we might get to some questions that there's been a lot that's happened in news cycles in the last couple of weeks since we first recorded our initial webcast. That might nuance some of our responses to these questions. But yeah, I think that it goes to the heart of the corporate culture and the board's oversight of that culture.
Yeah, I couldn't agree more. And I also think that it just speaks volumes about having that deep understanding as a board of what that culture is and how the culture's evolving and how this fits in. I think it's fair to say for some companies, this was fairly performative for a while, and as opposed to performance based. And so, and as you say, starting, where it should at the culture level. So I want to now go, because it's part of this E&S conundrum, to the second question, which relates to sustainability. For global companies, are you seeing changes related to sustainability? You think about the EU. If you're a global company, think about EU sustainability regs, California regs. I think they're still tied up in the courts, but this is now a crazy quilt given, again, the political and regulatory and other backdrops. So Jessie, maybe you could start here.
Oh, certainly for global companies, yes, the European regulations, CSRD, and various other international regulations are, front of mind and still requiring significant amount of work, reporting, compliance, team members, external resources, very, very important. But as you noted, Gloria, there's California, there are other state laws, Illinois, New York, New Jersey, Colorado, other state laws that are impacting or that are will begin to impact the requirements for certain companies based on, their headquarters or their presence in the US with regard to reporting. So I'd say at a high level, sustainability reporting has not gone away. And really depending on the nature of a company's operations, the SEC reporting, being tabled and almost certainly dead at this point, hasn't truly impacted the need to continue to report. So we haven't quite, came to a place where, you can say, this is all voluntary, I'm just going to do the right thing for our business. That's not true. We still have regulations that are permeating and that are continuing to expand. That said, I do think, and Paul mentioned this earlier, some companies have taken a step back from maybe more fulsome sustainability reports focus on greenhouse gas emissions, focus mostly on climate, and have either pared those back or tailored them more to various other sustainability type issues that are not as, data driven, not as simply greenhouse gas metric driven, and tell more of the story, the community engagement, their involvement that way, their human capital management, their diversity of thought and perspective, looking at sustainability in a more holistic way than simply, the direct impacts on climate from certain gas emission. So again, I've seen it as more of an opportunity for companies to tailor that disclosure to what makes sense for them and their stakeholders. But sustainability teams still exist. Work still needs to go into, complying and tracking that other information. And I don't want companies to get complacent, at least that's what I'm telling our clients, on these issues, because we don't know where the European and where these state laws will go. And so if you have an infrastructure already at the company that is tracking, that is staying on top of, all of this data, now is not the time to disband that, right? Maybe you take your foot off the gas a little, or maybe not, but let's wait to see where this goes in the next year or two to ensure that you still have, again, that infrastructure and that baseline reporting so you can comply if and when all these rules, really do take place, as some expect that they will.
And if I would, if I was sitting in the boardroom and I put myself in the role of a director, how quickly this is moving, I think, would be a key driver for the kinds of updates I'm expecting from my management team on how the news cycle is evolving. So you saw over the last week, for instance, there was a report about the EPA that was going to stop collecting emissions data from certain polluters. You had the SEC chair again sort of reiterate concern around CSRD. Not necessarily new, but interesting, right? In how both the political and regulatory environment will impact how companies are thinking about disclosure, how they're thinking about sustainability, and how they're thinking about to our initial discussion engagement with their shareholders and stakeholders around these issues. So you need to keep your eye. This isn't a quarter to quarter type of discussion. The type of interim reporting I'm seeing to boards around these issues has increased because of the speed at which the information flow is moving.
And that's a good point, Paul, about understanding as best you can what your investors want to hear, because that is what directors need to be asking as well, right? We've got the external political landscape and the rules, but the practical reality is, even if the rules aren't applying to the company at that point in time, our largest investors or our key investors still expecting to see this kind of information from us, and in what format.
And in many ways, to underscore both of your points, broader societal concerns that are shared by major shareholders and many investors haven't gone away. Right. So it's, talk about a balance beam for Beyond, and I'm thrilled to hear you talk about the ways this can be framed in positive approaches, Jessie and Paul. All good for our listeners. So let's move to the fun topic of shareholder activism. Paul, again, your data from PwC showed that fewer proxy contests went to a vote. Strong support for incumbent directors continues. But the activists gained more seats this year, settlements, targeted wins. And you did mention some different tactics. Each year they seem to vary in what's going to work, borne out by then the results, rather than, in this case, going to full-blown contests. I remember the year before it had engaging union support. I mean, it seems every year there's sort of this evolution and change for, which is tactically a good thing for the activists. But so our first question is, can you speak to the difficulty, and this goes back a little bit, sort of the flip side of the earlier question, but can you speak to the difficulty in identifying activists in the monitoring of changes in shareholder holdings? Not always easy to identify an activist or their true motives. So Paul, could you start us here?
Sure. So, some of this can get a little bit granular around the practicalities. It's harder than it looks. So, an activist can increasingly build an economic stake in a company, both with direct shares, with derivative shares. You could also have the sort of wolf pack mentality of a group of activists who are getting together, all of that before that information surfaces publicly. Most companies and boards will use stock monitoring services, right, to get a sense of changes in their shareholder base on a regular basis. And there's certainly reporting that most boards are receiving on that, but there's also the plumbing of that, and that's more of a legal issue. Jesse, you want to speak to that
That would
element?
be great, Jesse.
Sure. Yeah, and I don't know if we need to get into all of those details, but I'll touch on a few things. But to your point there, Paul, it's usually very difficult to understand, exactly who will come out of the woodwork as an activist. And maybe we should even say, what does it mean to be an activist? They can come in all shapes and sizes. It can be, an investor holding a position that tries to get the ear of the board, right, by sending a letter and making a phone call and communicating that way. And frankly, once we go deeper into your engagement pool, right, as we're talking about, as maybe as a strategy, you also sort of get the opportunity to talk to these investors. And the flip side is they have the opportunity to share more information with you and their views, and you need to react, right? So you have to be mindful that going deeper into your shareholder base for engagement also creates this, in theory, opportunity for activism. If we're saying activism is, we suggest you do X, Y, and Z, we'd like to talk to the board about that, right? So that letter can occur. You can have an activist, so to speak, who's issuing a shareholder proposal. And that's what Paul said, proxy plumbing. You don't need to have held very many shares for a very long time to be able to submit a shareholder proposal. That's a form of activism. You have obviously the larger kind of big picture splashy activists with the proxy contest, or otherwise. But I think a lot of folks listening to this call and a lot of my clients are more concerned about those lower tiers of activism because they can be just as impactful and frankly can be just as effective in terms of getting certain issues across and really forcing the board's hand to consider and to respond. So how do you figure out who's out there? We talked about a stock watch firm. We talked about a proxy solicitor, understanding who's, on your shareholder list. Obviously 13Gs and 13Ds, but, once somebody becomes at that level, you're already very aware. There's 13F quarterly reporting that your board and management should have some information around. Your IR team can share that. But then there's also maybe a little more kind of behind the scenes ways to see who's, as I said earlier, listening to your earnings calls, right? Who's logging into your earnings calls? Your IR team or outside third party IR folks should be really paying attention to that. Who's going to your website? There's a lot of opportunity to track, who's accessing your website and how frequently and what content. And I'm mentioning these because I have clients who, because they had their antenna up, have taken a look at some of that. Who's attending your investor conferences, who's logging in on investor day calls, really kind of putting some, parameters out there around who's paying a lot of attention to you. Can you see that if they're increasing their positions accordingly? And should you keep your eyes on those folks either proactively or reactively? What's that strategy look like? Again, all of this is, not to suggest it's a full mystery, but, they're incremental increases in holdings or increases in a way, like Paul said, that, might be affiliated parties increasing together. Not always going to be obvious, but perhaps there are other signs as to who might be really interested in you, your business, and the messages that you're communicating.
This is, I think, a really helpful, deeper dive than we were able to get into about going further down your list in the first program. So thank you both for that. So an additional question, which I included in this bucket because board effectiveness is not going away for shareholders broadly and for activists who might have a particular bead on individual director effectiveness and a whole host of issues. And so here's this question. It's a time-old argument, but how do you reconcile the need for expertise on the board with size and maturity of board and company? Very different for Fortune 100 versus the lower end of the Russell 3000. Does the question become more interesting when the SEC is trying to expand access to capital markets? So starting sort of at that front end, Jesse, you want to tee this up and then Paul, of course, add in.
Yeah, so you start with this idea, ideally, right, that a company has a skills matrix around, what would an ideal board composition be in terms of skills, backgrounds, diversity of experience, et cetera, right? Like in a perfect world, it's, what would we love to have on our board? What is great for us to have in the room in terms of oversight? Because this is a set of skills, a set of experiences that we don't think that we can easily pay for example, from an outside advisor, or maybe we need this in terms of business growth strategy, et cetera. And how many directors does it make sense for us at the size stage of organization we're in? Does it make sense for us to have around the table? And some of that can be just practical, just logistically. Some of that can be how much can we afford? Does it make sense for us to pay for directors, right? And then your question, or the part of the question is, and who's already there? Because we've already had this, long tenured person or people, and we need to keep this history, et cetera, right? And then that creates ideally an opportunity for them to say, we need this kind of skill, and we really can only bring one or two more people in. And so what are we going to prioritize? And it doesn't necessarily answer your question directly, Gloria, of how do you decide at any given stage or size of company how many directors you need or what skills you need, but it's a framework around which boards can really start to consider what is sort of the max that makes sense for us to have in terms of, directors. What is sort of the logical sort of tenure or horizon for the existing directors that we have? Hardest conversation, I think, to have, right? Knowing when people might roll off or you want them to roll off, and where are our opportunities going to be and when to add new directors. And then once you have that, what skills are you going to prioritize in those new directors? Are you going to be opportunistic, or are you going to look only for directors that carry those specific skills? All of that, makes the nominating and governance committee a really, really, really important, committee on the board, thinking through all of those various pieces.
So it's interesting, the fast evolution of AI use in companies, with core business uses and now beyond has there's a minority, Paul, I saw some of the data on this, a minority of companies that have been now looking to add that skill. And I remember very well the cyber security debate. Do you need somebody, or more specifically, do you need the CEO who has, a lot of information across a broad spectrum of issues, and that's up to each company. But how do you talk to your clients, Paul, about this?
Yeah, I mean, if I think back over the last 5 years, we've had essentially the same conversation around cybersecurity, then climate, now AI.
Yeah.
It all comes down to, do we bring someone with deep, but potentially deep expertise um, in that core skill set onto the board? You can choose to do that. There are other alternatives to that. The board can upskill itself through director education. You can use a specific advisor, right, in an area that you feel you need more expertise, but don't necessarily want to add someone with that discrete area of expertise. What I do think is that when in the discussion around board composition, we often talk about skill sets as we look through a typical board matrix. What we often don't discuss is the behavioral side of those individuals. And that is, are we bringing people onto the board who not only have broad experience and background and expertise in a particular area, but do we bring people who are lifelong learners onto the board? Do we bring people who are willing to have a dissenting view and express a dissenting view in a productive way? Are we bringing people onto the board, that have that will tend to dominate the conversation in the boardroom, or do we bring more collaborative people onto the board? And so, just as we're talking about the issue of what expertise does someone have, I do think boards would benefit, and particularly nominating and governance committees would benefit, as they're evaluating director candidates. Many of the questions tend to be topical. I would skew that toward behavioral, because ultimately, in the end, you want someone in an oversight role who is not an expert in every area, but being able to ask the right questions of the management team, understand when they don't know enough to know what those right questions are, and then to seek out the ability, to gain the expertise to know what those right questions are. All of that in operating in a group between 8 and 12 people, right, on average, right, where the drive is toward a consensus, right, which can then sort of put a board in a sort of groupthink mindset, right? So, in my mind, it's not only the question of what's the expertise of the person, it is what is the work style, personality type, behavioral approach that person brings to the board.
Yeah. Couldn't agree more. And the problem is too often the board waits until there's a problem in the boardroom. The lack of collaboration and collegiality, and in some cases, a lack of real independence. So, it's getting all of that right. And I think you just gave a really good version of how you get there. So thank you both. I might add one more question. I think we have a little bit of time, and I wanted to ask a little bit about 2026 voting policies, the guidance from large investors, proxy advisors adopting softer, less prescriptive voting guidelines to play out. Again, we're seeing the regulatory community, the case, Paul, that you had referred to at one point in Texas, where wanting ISS and Glass Lewis to disclose when they're using non-financial factors and having a darn good explanation of the advice that they're giving through a written financial analysis that when it varies from what management's doing. So when you think about this, what do you see going forward into 26? How are the proxy advisors going to be walking that softer line, if they are? And are there other pitfalls for large investors and proxy advisors alike when they're giving voting guidance broadly to companies? I mean, it's just different than it was a couple of years ago, or maybe.
Yeah. It appears to me that the changes are more incremental and more case by case. So, for instance, in 2025, you saw Glass Lewis address AI, right? A more topical issue. Say they were going to look at AI oversight at the board level on a case by case basis. My sense is that they won't generally recommend against a director absent, some sort of material harm, right, that has been witnessed. I think stances like that are likely to persist. Again, with ISS, you saw some incremental changes on some sort of governance policy issues. You did see it, obviously, in cases like BlackRock and Vanguard, a noticeable kind of softening, right, in the language, particularly around diversity and diversity metrics. And I think that's a trend that's likely going to persist into 2026.
Thanks, Jessie.
In some ways, that makes it more difficult, though, for our corporate clients to know what to say and to respond, how to respond. Again, I'm going to continue my theme, though. It's an opportunity for companies to really clarify their disclosures based on what's important to them in terms of their business model, their strategies. We talked about their board's view on, the significant areas of oversight that's relevant to that particular company in its stage and its growth trajectory. But it does require that proxy statements and other disclosures that are being, reviewed and part of the public mix by these investors and proxy advisory firms and all investors alike, and the SEC, never forget the SEC's review. But it makes the companies take a harder look at what they've done in the past. You can't just rinse and repeat, add a couple new sentences. Now's the time to take a really hard look at all the disclosures, how they work together. What governance story is the company telling? If we don't think that larger investors are able to engage in the same way, and we're almost certain that's the case, how are you communicating clearly what your strategies are in comp and ESG and sustainability and diversity and oversight of AI, of all these issues? How are you doing it in a meaningful way so there aren't questions, there aren't there isn't need for additional soliciting materials, that you're doing it right and doing it, carefully the first time. I think it really requires, and again, go back to calendar your companies, the proxy statement to be a priority, starting now in terms of some of the disclosures, giving it up, giving it to the right people to think about and look at now, not waiting until, the typical timeline where everyone might feel a little bit crunched, looking at this as a living, breathing document to give everybody the right amount of time for input, and then maybe getting to the board earlier than you historically have. So the board has more of an opportunity to really ask questions and to be strategic around disclosures rather than reacting, and getting a week to review it as some timelines, allow.
Yeah, I think that's a terrific place to end. The focus of boards and the companies really on their bespoke story and sharing their story in a really compelling, accurate way, while looking at the landscape and how it will be read by others is a great place. So it, to me, suggests sitting up even straighter in your board chair with that pencil sharpened, and just being ready through engagement, through doing a deeper dive into what the proposal landscape is looking like, the activist landscape, and then figuring out how should this story unfold in the midst of a lot of uncertainty going forward. But having that responsibility, which we've talked about shifting through the shareholder engagement landscape, but more broadly, fall on the shoulders of the people who know their company best. So I just want to thank you both. The fact that you have been able to carve out the time for two of these programs, this addendum to the first one, we couldn't be more grateful. And I know I'm saying that on behalf of both NACD New England and the Philadelphia chapter of NACD. So thank you both. Tremendous asset to this conversation. And we hope to see you again soon.
Thank you, Gloria. Thank you, Paul.
Thank you both.